right. All right. Welcome back. Welcome back. Welcome back to another episode of Take Profit Tuesdays. This is your host, founder, CEO of Vonnie FX. And today, we got a lot to talk about. So make sure you get your popcorns ready, your snacks, um, whatever you're gonna need to, just enjoy today's content, today's outlook, today's advice, and yeah, let's get jiggy with it. So, to start things, as I always like to start the videos, I would like to repeat this is not financial advice. If you do need to seek a licensed broker, a licensed salesperson who is licensed to do these kinds of investments at a very institutional level, please seek to invest your funds with them. You may pay a commission. You may do whatever you can. Just as long as you sign that agreement, you'll be okay. I do not I do not shy away from the professionals. But if anyone would want a chance to, take an opportunity to learn how to invest in themselves with confidence, well, frankly, you're in the right channel. So, as I'll repeat again, today's content, this channel, is not for financial advice. It's strictly for entertainment, education. Again, we do teach the principles of the four pillars, as far as capital, strategy, risk management, and psychology. We've been doing this since 2019. So if this is your first time coming onto the channel, please subscribe, hit the like button, and the noti bell, so you get those notifications, right? Um, Again, if you do, the markets are very volatile. If you're not aware of these, at least principles that we teach, we I would not advise you to blindly and risk all your, life savings, your funds, into the markets, and then you're broke. We don't want to be there. I would not want you to be there, and it's not a fun place to be. We kind of worked hard to where we are today, right? Yeah. So again, please seek a professional. Please, um, seek someone who's licensed, been doing a very long time. There's a lot of institutions out there. I don't promote any of them unless they're sponsoring us. But anyways, we had a long, I guess, somewhat a sideways week, which is something I've been predicting, something I've been kind of expecting, to be honest. Kind of like a leveling out before we get a run up. Um, there's a lot going on, and this is why I took the time. This is why I titled the video today, "What do we expect in the future?" And to tell you the truth, I don't know. I really don't know. I can only tell you what's happened in the past. I could tell you what the fundamentals are. I could tell you ideas. I could tell you theory, but I can't tell the future. Um, but in the same breath, with the information we have in front of us, at our disposal, for those who have information as well that's not public, they can use that to their advantage, right? It gives you like an edge on things. And what is wrong with having an edge? It's like, when you're taking an exam, right? You have 2 weeks before the exam comes. Are you just not gonna study? No, you're gonna sit down. You're gonna get your book, get your pencil, get your textbook, and you're gonna study for those 2 weeks. So why? So you have an edge. So like us, we take that, like I said, the four pillars, and that gives us the edge. So now, again, if you're not involved in any of the, products and services, or even part of the membership, it'd probably do a good justice. We're working on a lot of things. A lot of things. We just finished one of our first master classes. We're gonna have another part two coming in the next couple months. But anyways, with the war still going on, with a lot of the companies, the rates, there's so much things going on. A lot of what we like to call uncertainty. And with a lot of uncertainty, we don't know what to expect. And with a lot of uncertainty, we have a lot of people who are very fearful of what's going on, right? When you see the market drop, let's say 20% from its most recent all time high for the year. Let's say for the year, just for this year, right? That brings a lot of fear, anxiety, worry into that, let's say, investor. Now, if you're someone who's not very familiar of what's going on in the markets, then you're just gonna be very confused. You're gonna be a quitter. You're not gonna know what to do, and that's fine. Why? Because you're a newbie. You're just getting your feet wet, right? And again, there's a saying in the industry, when those that are fearful, there are those who are greedy. And if you take a couple step back and you think about what happens during those times, war, tragedies, all these bad things, when people are very uncertain and fearful. On the flip side of that coin, there's a lot of people making money. All right, but we'll talk about that a little later. So now, and again, if you're tuning in, make sure you like the video, subscribe, hit that noti bell. Um, my predictions right now for the S&P, it's yeah, it's down, and I'll tell you what, we said it on the channel, we're gonna disclose how much we invested, so on and so forth. We're gonna be doing it together, cause we're transparent. Give me 1 second, guys. Let's see if I can find it. Holding tight, hang tight. I'll actually tell you right now on live what's our balance on this what are we gonna call it, guys? A trading group, the trading group fund, when it's actually my funds. Yo, I need to get a stream deck for this stream, man. I could be adding so much sound effects. All right, so as far as let's say a team effort of our investing profile, as far as just the index, just learning how to get into the good positions and holding it long term. Because again, if I pull out, I'm gonna let you guys know, right? And when I buy, I'm gonna let you guys know. Like I said, I'm a long term player, guys. I don't really play any games. So right now we're down about 6.1% total, right, from our 3 points of investments. And to be honest, that's a lot of people. Let's say you have $6,000. Well, sorry, not 6,000. Let's say you have $10,000 in there, right? That's like a $600 loss. Most people are like, oh God, I just lost, last month's, car note payment or whatever. They're like just very fearful, and they're like, let me just close this before it goes zero. And again, guys, when you don't have all four pillars, you're doing yourself a disjustice. And if you're not investing with at least a professional, you're really doing yourself a disjustice. And to be honest, that's not fair. That's not fair at all. So now, if you made this far in the video, you're probably asking me, all right, Leo, stop talking. What's your prediction? What do you think's gonna happen? And I told you already, I don't know. I really don't know. But I'll tell you what I am gonna do. As I told you in previous videos, when you don't know what to do, you wait. You wait. And you know what? I am gonna keep waiting. Why? To get to a better, cheaper, position. It's already at another support right now. To be honest with you, it could go even lower. It could go as low as right here. And to be honest, guys, we're on the weekly, so it could go as low as 37.24. Point five. Is it gonna happen? I don't know. It's very volatile right now. And like I said, I can't tell the future, but you know what I am gonna do. And I already told you, I'm gonna wait. So if you want to get into a good position, or if you want to get into now, it's up to you. Again, it's not financial advice, as I said in the intro, and I'll repeat it again. If you would like to invest into the markets and be a part of it, and it's a very risky investment, risky market. There's a possibility of using all your funds. Um, Find an advisor who could invest their money wisely. And again, this is not a financial advice. This is strictly entertainment education. All right. So now that we're like I said, guys, it's gonna be a long stream, right? Because there's a lot going on. So what else I want to talk to you? Let's do some fundamentals. And I do want to talk about different kind of stocks and companies and what's going on in the world, right? So this one says, let me zoom in. I'm kind of blind, tad bit blind, guys. I'm so sorry. Getting old. Um, Starbucks to exit Russia after nearly 15 years. There's a lot of other companies like Dunkin', and some other ones that still like operates in the U.S. or headquarters in the U.S. But still has operations such as like franchises in these other countries, such as Russia, when there's a war. So they're kind of, in my opinion, supporting the war. Um, are now deciding to pull out because of their the public image. So now it says Starbucks Corp says on Monday it will exit the Russian market after nearly 15 years as a coffee chain that joins McDonald's Corp into marking the end of the presence of some of the top Western brands in the country. So again, not only just Starbucks was doing this before as one of the major chains in the states, but now McDonald's. And they only been in Russia for 15 years, almost 2 decades, which is, in my opinion, not a long time. You could literally start building up a decent pension and like, oh yeah, we're leaving. You know. Seattle-based Starbucks has 130 stores in Russia, operated by its licensee, whatever group, with nearly 2,000 employees in the country. That's a lot of employees, in my opinion, too. With 130 stores, that's a lot. Starbucks' decision to wind down its operation in Russia is different to the approach some other foreign companies have taken. McDonald's last week said it was selling its restaurants in Russia to its local licensee, Alexander Govar, to be rebranded under their new name, but will retain its trademarks, while France's Renault is selling its majority stake in Russia's biggest car, car maker, with an option to buy back the stake. Interesting. This kind of says a lot. And again, they're just winding down. People want to rebrand. What's going on? Because again, guys, like we said before, during these times, a lot of people they're getting very uncertain. So when you're uncertain, you got to be very strategic. And I think I mentioned before, um, people are gonna get greedy, man. People are gonna get greedy. So I do want to segue to something else now. Wait, hold on one second. Let's see. I think there was a point I wanted to also talk about. I think there was definitely a point I wanted to talk about. Oh yeah, that's pretty much Gives this kind of gives you just an idea again how you know the war affects what's going on in the U.S. as well as far as gas pricing, which we'll probably get into as well, and the stock market. Because again, now when Starbucks now probably one of the top five companies listed probably on S&P now has to pull out from a country which is probably earned a lot of money in that region, right? It's a very popular chain. Everyone almost knows Starbucks by its logo, right? 1 second. So now we have to segue to this one, and this also affects the market as well, which is I'll explain. Here's why workers quit during the Great Recession by Ella Vincent. So, what's fueling the Great Recession? One survey has dug into job hopping. The biggest factor are money and career growth. A recent Pew Research survey of workers showed nearly two-thirds of respondents citing those as majors or minor reasons they quit their jobs in 2021. Right? No career growth, no money growth. You're stagnant and you're still working the same position you're doing, but just in worse conditions. Right? Why would you want to stay in that, especially at the point of retirement? Right? For those who are obviously feeling disrespected at work came in a third, with 57% of workers citing it as a resignation factor. Other big factors behind quitting included flexibility benefits and better hours, right? Everything changes. It's a shift. No one wants to work, right? And I'm kind of going to tie this back into the market, obviously. Um, with a record 4.5 million people quitting their jobs in the March alone, the survey underscores that workers continue to take advantage of the labor imbalance set off by COVID to find better employer-employee match. The pandemic opened up opportunities for many workers. Kim Parker, one of the authors of the study, told Yahoo Money. Right? So, in my head as well, I thought like not a lot of people off. They're gonna have to sell a lot of their assets. They have to move. They have to downsize, and take money out to live and buy food and pay bills. So now we're gonna get that money from their funds. They're gonna pull out. So it only makes sense. It only makes sense. So real quickly, kind of goes back to the rate hikes that we talked about a while ago. The stock market is acting like it believes Jay Powell. Morning brief. Emily McCormick, reporter. So she says the stock market isn't trading like it's expecting the Federal Reserve will swoop in to save it. And to be honest, it probably won't save the market right away. It's gonna probably take a long time, probably a couple weeks to months. The S&P has tumbled by more than 17% from its January record high through Monday close. The index has posted monthly losses each month this expected, except March, and it's on track for another slide in May. The Nasdaq Composite has fared even worse, plunging more than 228. Sorry, not 280. From its record high from November 19th, as once high-flying tech shares have been especially battered. Market participants in the past haven't trusted Fed's officials to stay on the course their telegraphed monetary policy path. When faced with this level of market volatility, the tendency by the Fed to be spooked by market turmoil and concern into easing monetary policy has been known as the proverbial Fed put. So, what does that mean? Again, people are hoping when the Feds increase the rates for these monetary policy that it'll save the stock market. And guys, to be honest, it's not. In my opinion, right? Why, Lee? When you ask, why do you think it's not gonna work? Because what the Fed does not directly, affect the stock market directly. If anything, to be honest, guys, it's probably gonna do it worse. Why? Because if rates are gonna go up, where people are gonna get the money from to pay for the extra interest onto the money they're borrowing from the banks or mortgages and so on and so forth. Because again, it's a trickle down effect, like we spoke about before. If the feds are lending out money to the banks and increasing the rates, banks and lenders are also going to increase their rates to compensate the difference, to increase their profit margin. So with that being said, now you as an end consumer are going to pay the highest interest out of all three um participants within that transaction. So if you're a smart individual, well, if you're an individual who had no options and had no funds still available ready to, let's say, combat that interest, you're mostly gonna sell assets and move funds elsewhere, right? And we're gonna get those funds from stocks, bonds, so on and so forth. So realistically, it'll be great if this could help out the S&P, but in my opinion, I don't think it will. Not at least not now. It definitely is not now, because again, what the Fed's job is not to save the stock market. Their job is to help monetary policy, which is essentially the price of goods and services in the states. So what their job is essentially is to combat the inflation going on, and set rates as far as lending and borrowing goes. So I know that was a lot to take in, but we're kind of like in a standstill, or like a slip and slide, I'll say. Let's continue. So what else you got? It's a graph. Of two indexes, S&P. So let's continue. As recently as 2019, the skepticism as well paced, eyeing as softening economy, trade uncertainties, and stock market in turmoil. The Fed delivered its first rate cut in over a decade, backing away from its plans to raise interest rates further after hiking around 2018. The market in early 2019 bet the Fed couldn't carry out the rate hikes it had suggested would take place for that year, and the market was right this time and around. However, commentators and are confident the central banks won't react the same way, and I kind of also agree. So we'll just wrap up with this paragraph again. If you're joining the stream, make sure you like the video, comment something nice, hit that noti bell, and subscribe. So the Fed put pattern of behavior established a clear precedent that many market participants are still clinging to today, even as the community discusses rate hikes while the equity markets pushes through key support levels, which is almost in right now. Stephen R., U.S. chief economist of Mizuho Securities USA, wrote in a note Monday, "Our continued bearish call on the equity market is predicted on a view that the put option no longer exists." So they're saying the put option, again, if you know what puts are, it's just basically betting on a downward trend on the market. So they're saying there's no more put options. So they're essentially saying how it might go up. But again, guys, you can't really tell the future. So with that being said, again, if you're watching this, I want you to tell me what you think from what the information I gave you. I want you to tell me if the information I gave was sufficient, and if it makes sense. And the previous videos that we've done, they kind of almost had hammer and nail, as far as where the market was going with the war and recovery and all this rate hikes and everything. It's interesting. But let's look at the dollar real quick while we're at it. Then I'll wrap up the video. So the dollar has been climbing, and then recently, these past couple of days, it's been taking a hammer. Even today, it's taking a big hammer. So the Feds, they're doing their job pretty well, right? Would you agree? You can see as far as the devaluation of the dollar, so inflation is going down because the dollar value is going down. I'm possibly gonna wait for a point to get to a sell and put some more puts, or maybe I'll buy Euro USD and look at some of the other pairs. But oh, give away too much secrets, guys. I don't want you to watch that. Anyways, that's the end of the video. Tell me what you guys think in the comments below. And I'll catch you guys in the next video. Peace.